Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
Welcome to The Real Investment Show. I'm Danny Ratliff here with John Penn, filling in for Lance Roberts as he gets a little bit of R&R this week. He says he's taking off, Brent. I'm not real sure he is. He claims he's going to be on each one of our meetings this week. Which
I
John,
have not seen one tweet out of the man in a week.
Well, that's impressive.
That is very impressive.
I'm happy for him. You know, everybody needs a little bit of a break here and there. I know it's been a while since he's seen his son who's been in Germany, so COVID's screwed that up a bit, so it'd be nice for him to get out and about and travel a little bit. I hope you guys had a great 4th of July week. Volume was light last week. We're kind of getting back into the meat of things once again here as we're going to get some earnings. Big news over the weekend, though. Elon Musk backs out of the Twitter deal.
He did.
Now, this is pretty interesting. I mean, there's a lot of things flying around about this, and I think, you know, one thing to watch is a lot of people are saying this was just a cover for him to actually sell Tesla shares. So kind of an interesting story dynamic there and maybe a plot, a twist there.
Twitter shares down, 7% in pre-market because of this. I just dig his picture with the sunglasses, with the shades. What a cool cat. I think, can we do that?
No, I don't think so.
Sorry, I didn't mean to digress. It's too early to do that.
No, I don't think I could pull that off. I mean, but yeah, so, Tesla, maybe they get a little bit of reprieve after they saw that little bit of a downturn there for a bit. But market futures pointing down for the moment. We're also seeing yields drop just a bit. Market's still trying to digest jobs data from last week, inflation numbers, 3-year inflation expectations come out today. New York Fed, John Williams is going to come out this morning and talk about, or this afternoon, talking about the move away from LIBOR, what that means for markets. Going to get some more information this week, back to retail sales, initial jobless claims. So as we get towards the end of the week, we're going to get a lot more information. But, right now it's been rather interesting. We've been bouncing around quite a bit. Last quarter, obviously not a good one. We have seen yields come down a bit where we've seen quite a bit of a swing there, John. I think it's really been taking people for a ride in the sense that, we've seen 10-year Treasury yields up to 3.5, all the way back down to 2.7, 2.8. Now we're back above 3 a bit. And so I think it's really difficult for people to kind of really determine where they are. So we're going to talk a little bit about that. What do you do in markets where there's so many swings, especially in this environment where, nothing seems to be working except for cash? But do you bail? Or do you stay? And I think that's the question for many, and you need to understand where you are. So we're going to talk about kind of a down market survival guide for people, pre-retirees, people who are in retirement. What does that mean for you? 5 surprise retirement expenses. Now, we hear this all the time, talking to many different people. Folks are dealing with a lot of different expenses, especially right now with the inflation as high as it has been. And so we really want to dive into some information about that. And then what do you do talking about finances with aging parents? That's always
seems to be a very challenging conversation to bridge, or just how do you introduce the topic to make sure that that mom and dad are taken care of, right? Or just other, even not just mom and dad, but other significant members of your family. And just, how are some ways where you can approach that? I know, Danny, lately I've been getting a lot of questions about it from existing clients that I'm working with where they say, hey, John, would you mind talking with my mom and dad, or just kind of visiting with them a little bit? So sometimes it makes sense to maybe bring a third party in. So we'll definitely expand on that, talk about that a little bit later too.
Yep. So, lots to get into today, as well as, COVID restrictions. Looks like China is having some issues once again, sparking growth fears. Obviously a pickup here in the States as well. So a lot of information that everybody's trying to understand and really get their heads around. And so I think that, when we look at the markets right now, we need to really understand where you are as an individual and a family as far as what that means for you, and not make any rash decisions. I think that's going to be one of the bigger things here. What we've seen and, looking at an earnings recession is what we've been expecting here. Lance has been writing about it. We've been underweight equities, underweight fixed income, overweight cash, which, like we just mentioned, that's been one of the better places to be, unfortunately. And, I think that's going to change, though. And so one thing that we do see is a lot of optimism in the sense that there's going to be a lot of opportunity here in the future, not just in stocks, but bonds as well. But it's going to be key to understand where you should be invested and where you shouldn't. And, we've been doing some things where people say, hey, what are you guys doing in the sense of placing a trade? We've been trading more than buying long-term positions. Now, there are some things that we're kind of making that list and checking it twice, so to speak, and that we are finding some opportunities that I think we're going to be able to capitalize on here, but maybe just not quite ready yet. Added some trades, had QQQ, full disclosure, we've owned that, liquidated that last week. Looking at, some other small positions as we get back into earnings season once again, and we've been beginning to get more data. But, like I mentioned, volume has been extremely light. We've been hoping for that to pick up some, to really get some type of, strength into a rally and get some conviction, but we haven't seen it. And, that's one of the things that Lance has been watching for, and Mike. And, one thing that I think people maybe, it's paralysis by analysis to some extent. And then you also have people, like Lance, who maybe just decide to take a couple of days off.
Yeah. Well, and I think too, I've been hearing from a lot of folks too, Danny, where, we're just so bombarded by financial news 24 hours a day. It's on our phones. It's on all of our apps. And they're just at the point where, like, John, I'm taking the apps off my phone. I'm just not going to look at it. I'm not going to let it suck me in every day. I just kind of need to take a step back and get a kind of a fresh perspective. And then, like you mentioned, I need to see where I'm at. How am I currently positioned? Take a fresh look at it, because the media isn't doing us any favors by trying to draw us in and trying to get us with all the headlines and all the red on the screen to really pull you in. I mean, that's what they want us to do. They want to pull you in. They want you to listen. They want you to click all over their website. I get it. But every once in a while, you kind of need to take a step back. It's so easy to get kind of pulled down into the weeds of the day-to-day market gyrations. And you need to take a step back, and you need to come up and look you need to look over the forest a little bit and just say, okay, just how am I positioned here? If you feel like you're taking too much risk with your portfolio, if the market volatility this year has been unnerving, then maybe use some opportunities. I know Lance mentions this all the time. If there are periods of market strength, maybe that's a good time where you can kind of trim into that and raise a little bit more cash.
Right. Not
saying, hey, you need to abandon and go all to cash, because how many folks do we visit with that went all to cash and back in the great financial crisis in 2008, and you never got back in, and you missed out on
they're just getting back in.
Yeah. And it's hard. It's emotional. I get it. I mean, it's how we're wired.
And it's people's livelihood. So, I mean, it's your security. And so you need to understand that, how this works. And unfortunately, the emotional side, it gets the best of us many times.
Sure.
And so I can't tell you how many times we've visited with somebody. I'm sure you've encountered this as well, John, where, you're walking out of the office and the wife pulls you aside and says, hey, we've never made any money in the markets. And, you start to figure out why, because the moment that, it goes down, with any significance, they pull all the way out and then they never get back in. And so we're doing the complete opposite of what a fundamental investor should do, which is buy high and sell low. And we know the number one rule, yet it is one of the hardest rules to follow, because nobody wants to buy when there's blood in the street.
Right.
Warren Buffett says, be greedy when others are fearful, fearful when others are greedy. And, that's one of the more difficult things to do, because everybody wants to ride it up, but nobody wants to start buying when things are down and have actually, depreciated quite a bit. And so that's where, we talked about the optimism aspect. That's where I feel a heck of a lot better about it.
Absolutely.
And where that we're going to find that. And we've already seen a significant leg down here. Doesn't mean we may not see more, but what if you didn't? I mean, the thing is, we always try to rationalize these things, especially as they go down. And, look, there's a lot of headwinds out there, but things could change quickly. The Fed could turn course here. I think these are going to be things to watch for. Inflation. Inflation, we're getting a lot of conflicting data on that. Inflation is going to last until 2024 is now the news. Inflation is going to come down by the end of this year. I think we'll see a little bit of both, right? We're going to have some inflation. It'll be a disinflationary environment. We just won't have as much, which will be great. Hey, you listen to the Real Investment Show. Lance Roberts is out today. I'm Danny Ratliff with John Penn. We'll be right back after this break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hurricane season is here, and along the Texas Gulf Coast, we know how to prepare. What we don't always know is which way the storm will go, and if a hurricane does come your way, whether your house will flood. Fortunately, you can get flood insurance. Unfortunately, flood insurance rates have skyrocketed. Don't be at risk. Let the specialists at RIA Insurance assess your needs and shop your coverage for the best rates possible. Another service from realinvestmentadvice.com. Click on the insurance tab, realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Could your job still be at risk? A new normal can still include new obstacles. A severance package can be an emotional as well as a financial decision to consider. Wouldn't it be comforting to review the options for you and your family with an objective financial partner? At RIA Advisors, we're here to help. From severance pay, tax timing decisions to how to maximize unemployment benefits, the RIA team wants to make sure you can do what's best for your family. There's no charge for a consultation, so reach out to RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the Real Investment Show. I'm Danny Ratliff here with John Penn. So a lot of talk about inflation. 3-year inflation expectations come out today. Last print was 3.9%. We'll see what we get today. I would expect that we will see this decline a little bit over time. But one of the things that we can see and we can control to some extent is retirement expenses.
Yeah.
But man, there are a lot of things that come out and just kind of sideswipe people. They blindside you. And, we talk about this on a regular basis on things we can control. And there's some parts of this that we can, there's some parts that we can't. You can't control the price of beef or how much a carton of eggs are.
So can I just talk about beef for a minute?
Yeah.
Great. So over at the Penn household, last week, I was working from home one afternoon and my wife was in the kitchen and our youngest daughter, she's a freshman in college, but she's actually staying with us this first year, helping mom and dad with a little room and board. Hey, and
much appreciated.
Much appreciated. And my wife had just gone to the store, and she brought home a steak, just a flat iron steak for me to cook on the grill that night. And I overheard my wife and our youngest daughter talking, and I overheard my wife say, "Hey, Dad's going to be grilling steaks tonight." And our youngest goes, "Well, what cut of meat is it?" And I said, "What?" I had to open my door and I said, "What did you just say?" She said, "Well, what's the cut of the meat?" I said, "Well, for you, it's free.
Yeah.
It's a free cut. So what doesn't matter if it's New York strip, whatever. Did you have to pay for it? You'll like it. Don't worry." But yeah, be just the price of beef alone.
Yeah. It's crazy.
Crazy.
We did the same thing. We actually split one. Like a flat iron steak. And so, it's the kids are like, "Hey, where's mine?" Like, "This is yours. We're going to cut it in pieces."
Right.
Everybody, I cut them a little bit smaller pieces so they feel like, they're still eating a lot.
It's the communal steak.
It's the communal steak. Even the dogs are like, "Can we have some of that?" Like, I don't know. I might have to fight you for it.
Yeah, not this year.
Yeah.
Well, and that's interesting because, we've talked about this too, but the cost of a barbecue for 4th of July went up exponentially. It's like 36%.
Yeah.
And so people are feeling that. And, I think people are beginning to change. We're beginning to see behaviors change. People are saying, okay, you know what? You don't get the New York strip. You get the flat iron steak, or you're going to maybe skip it altogether and buy something else. Hot dogs have even gone up.
Yeah.
It's wild. I mean, I watch it with the kids. So, but one of the bigger things that we see is hidden housing costs.
Yeah.
And John, maybe talk a little bit about what people fail to account for.
Sure. I think it's when it comes to housing, I think when folks are looking at budgeting their expenses, especially if you're transitioning into retirement, it's if your house isn't paid for, and nearly 80% of those aged 65 or older typically own their homes. That's according to the Joint Center for Housing Studies of Harvard University. But even those that do have a mortgage, they plan for their mortgage payments. Right, mm-hmm. They plan for paying their principal and their interest, but then it's the other things that maybe we don't account for. Like, does the house need a new roof? Do you need a new AC unit? Do you need a new hot water heater? Whatever that may be, And so kind of a good rule of thumb that we see folks maybe not take into consideration is maybe take the value of your home and multiply it by 1%. Take 1% of the value of your home, and that could be a good rule of thumb as far as what your annual maintenance costs will be for taking care of the house. It's all of those unexpected. It never fails, especially in Houston, July, August. What happens? AC unit goes out. I've seen so many AC vans up and down the street this week.
Well, that's right, and they're tough to get somebody if you need something quickly. I mean, now it's almost an emergency call. Oh, you want me this week? While it's 106, yesterday it was 106 degrees.
Yeah.
Today I think it's supposed to be 102.
Yeah.
This has been a rough summer.
We had a little rain last night. So
did you get the rain? We saw the thunderstorm. We didn't get the rain. I'm like, you got to be kidding me. The yard was crying for rain. But that's true. I mean, I can't tell you how many people this summer have needed new ACs. I mean, they're working in overtime here, and it's one of those deals that's pretty difficult. But another thing that we discussed, and people I think you see on a regular basis, uncovered health care.
Yeah.
Those expenses that people just don't account for, and it's one of those things in the sense that what Medicare covers, and Medicare Part A, that's going to be your hospitalization. You're going to have a deductible. Your Part B, that's going to be what most people will use for your your preventative care or your just ongoing doctor's visits. But some of the things that it doesn't pay for, and Part D is going to be your prescription coverage. But, many people don't realize once you get into, get on Medicare, it doesn't cover hearing. It does not cover your vision, and it doesn't cover dental. So these are policies that, they're not too expensive, but you can purchase those kind of a la carte. And then, it's all the extra things that go into that many people just don't say, oh, shoot, I didn't realize I was going to have to pay X amount, or my co-insurance was going to be this much before I met my deductible. And that's where I've seen a lot of people this year. I mean, just having, as things flare up, old injuries, needed surgeries, things of that nature.
Yeah, and so that's why I know just even in our own financial plans, Danny, when we put financial plans together, when you look at what your expenses are, what you think they'll be, to get a good idea about what your baseline expenses will be, what does it cost for you to kind of keep your lights on, keep food on the table, keep fuel in your vehicles, but then what do you think, what about your medical care premiums, whether if it's Medicare or maybe if you're a little bit younger than 65, you're not quite 65 years young yet, maybe you're on a private policy or what have you. We separate those medical expenses into their own separate category.
That's right.
So that way we can apply a much higher rate of inflation to those, because typically your medical care expenses grow at a much higher rate.
They do.
Right? And then if when you turn 85 years young, we'll even add some additional out-of-pocket expenses in there, because just as we get older, it costs more to maintain ourselves.
That's right. And, we talk about this in a lot of different ways. And so, we call it the retirement smile.
Yeah.
It's kind of a goofy way of looking at it. But as you retire, you're typically checking bucket list items off, so your expenses are higher. And then we begin to see it come down over time. And then it actually starts to come back up, about 85 because of healthcare expenses. And, that is where I think gets a lot of people in understanding, how to actually put that into a plan, account for that. And then inevitably, we see in times like this where people, they just start cutting back automatically. But I'm having a lot of clients who, they were checking those bucket list items off. And some of them are still doing so and doing just fine, while others are saying, hey, whoa, we're stepping back. And I know we've talked about this quite a bit where, just sharing experiences. There are a lot of people who are just saying, hey, I'm not doing the traveling right now. It's too expensive, or I don't feel good, or I want to wait for the portfolio to kind of come back a bit. And that's why it's so important to make sure that, you update the financial plan, understand where you are, because many times, especially the way we look at planning, and we really, we're planning worst case scenarios.
Right.
So 90 some odd % of the time, I would say, probably closer to 99. If your plan showed that it worked, it still works today, unless there was just something, really, really off.
Well, you mentioned that maybe some folks are kind of pulling back on spending on their vacations a little bit. Well, I've found that they're taking that money and they're putting it into their health savings accounts.
Yeah.
Love the HSA, right?
Absolutely.
So triple tax-free benefits there, deductible contributions. Earnings grow tax-free, and if you make a withdrawal for a qualified medical expense, it's almost like an IRA for savings in my mind.
It is. The problem that the mistake many people do is that they don't use them properly, right? We confuse them with an FSA, which is a flexible spending account, which historically has to be spent each and every year or up until March of the following year. And on an HSA, a health savings account, you can actually put those funds aside. And if you don't touch them, I mean, what we prefer is that you pay those out-of-pocket expenses, out of your pocket, and then any of those medical expenses, you're not going to use the HSA for. You're going to continue to let that grow because you can roll that over from year to year to year, and then utilize that. I mean, we talk about the numbers in retirement for somebody who's 65, a couple. It's astronomical. HealthView Services estimated it was $300,000, 2 years ago. You're getting closer to $500,000.
Yeah.
I mean, with what somebody's going to spend in retirement on healthcare expenses. And this is looking at, any of your insurance premiums, your deductibles, any of your out of pocket. I mean, this adds up quite a bit. And that's another thing that blindsides a lot of people is just that overall expense.
Yeah. And it's, we need to build that into the plan. We need to stress it.
Yeah.
And does it work? Right. And let's just, it's kind of the harsh, it's kind of like the gorilla in the room. It's everybody kind of knows it's there, but you really don't want to approach it.
Well,
you just need to
it's later, right?
Yeah. It's kind of down the road. And then all of a sudden 20, 25 years goes by and you're like, wow, probably should have planned for this, right?
Well,
or put something in place maybe.
That's right. That's right. We went to the beach for a couple of days this last week and, kind of speaking of planning, and my daughter, who's 9, has been wants us to go parasailing. And I said, okay, you know what? Let me see if we can figure this out. So we go parasailing. We're with 2 other families, and it's just her and I, and we're sitting there, and these other couples are just freaked out, nervous. I'm telling her, you know what? Hey, it's going to be all right. Don't listen. Don't worry about it. And she was cool. No big deal. But they started talking about wills. Do you have your will? Do you have this? And this is kind of the same deal. We delay these things, the inevitable that we don't want to discuss. And the same thing goes for healthcare coverage and understanding that, saving for it. The HSA is a great tool that many people just fail to use or use properly. Same thing goes for all those other things that, we have to talk about our mortality, or, hey, I'm healthy today. I'm not going to worry about it. I'm going to be healthy later. When unfortunately, that's just not always the case.
Yeah, I know the last time we were on together, Danny, we were talking a little bit about the estate planning piece. And again, we're not estate planning attorneys. We don't prepare wills, documents, and such. But I met with a couple last week in their early 80s, and one of them has some pretty serious health issues. I'm not a doctor. They were just telling me what was going on with them. I didn't diagnose them. Don't worry. But and I said, well, when's the last time you had your estate planning documents prepared? And they kind of looked at each other, and there was complete silence. And they said, well, we haven't done it yet.
Oh, man.
And they said, this is something that we've been trying to kind of put on our list of things to do for the last 20, 25 years. 25 years. And we just haven't gotten around to getting it done yet. And I said, we're going to make 2022 the year. I'm going to help you get this done.
Well, you can make an argument that that's something they need to do before we even move forward with anything
else. That is the first step that needs to be taken care of.
Number one thing, make sure you have your affairs in order, because we don't know when that expiration date is. But hey, you're listening to the Real Investment Show. Man, I'm struggling talking today, John.
I am too. I think I need just more coffee.
Yeah, that's going to be during the break. All right, you listen to the Real Investment Show. We'll be right back after this quick break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Every day this week so far, CNBC. Markets in turmoil. Every day. Yes, we know. We get it. Markets are in turmoil.
Is that like starting every newscast with breaking news?
Yeah, CNN recently is making some changes. They're actually going to stop using breaking news as much.
The Real Investment Show podcast. Same show, your schedule.
They broke the breaking news. Not every story is breaking news.
At realinvestmentadvice.com.
Not every story is news.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Have market gyrations caused you to lose sleep? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA advisors. Our disciplined approach can help eliminate unnecessary risk. If you think it's time to work with an advisor who puts your interests first, it's time for Real Investment Advice. RIAadvisors.com.
You're listening to The Real Investment Show.
Welcome back to The Real Investment Show. I'm Danny Ratliff here with John Penn. Hope everybody's off to a great Monday. So Brent always puts these great kind of jokes or one-liners, just good sayings. And today I do kind of especially like, in light of all that's going on, it says, at this point, if I get picked up by aliens, I'm just going to go ahead and consider it a rescue mission instead of an abduction.
So take me away. I'm ready.
Is that what Rich is?
Strange times. No, Rich is trolling you on the YouTube chat window.
Yeah, I've turned that off today. So Lance isn't here. Figured it had to be Rich.
We're in a safe zone.
Yeah.
Everything's good.
It's all good, all good. So the U.S. Department of Health and Human Services, talking about healthcare costs or surprises, they estimate that close to 70% of today's 65-year-olds are going to require some type of long-term care. The average is typically about 3 years. Typically starts when you're age 80. But the cost is what is just, it's mind-boggling for many. And I think this is what, John, unfortunately, people hear these numbers and they say, you know what, I'll never be able to save that. I'll never get there. But the average cost was $61,776 in 2021 for an in-home health aid. If you wanted a private room in a nursing home facility, it was $108,000.
You just kind of take a step back for a moment and you look at that number. And I don't blame folks for kind of being overwhelmed and saying, I need to take care of my own retirement, my own expenses, let alone that.
That's right.
It gets to be very overwhelming.
It does. Well, and I think some of the problems that we have with this is that we don't back into these numbers as far as how it gets there. It's like, you know those numbers of what is your number for talking about retirement, what you needed to retire. And I think that's the number one question you probably receive as well is, how much money do I need, John? And I tell people all the time, hey, I've told people with $500,000 they can retire or even less. I've told people with $10 or $15 million they can't.
Yeah.
because it's all about what the outflow is as well. What are your expenses and lifestyle expectations? But something like this is a necessity to some extent. Now, most people rely on, you're going to rely on your spouse or a family member. I mean, I'm hearing more and more people say, "Hey, my kids, those are my built-in home health aides," right?
Yeah. It's like, well, have you spoken with them about that?
Well, that's the other deal.
Have you asked them about it?
Yeah. No, they're not going to have much of a choice, though. It's kind of what I think a lot of people feel.
Yeah.
And I know there's a lot of kids are more than willing to do so, but that disrupts. We see a lot of retirements or people's work time in the workforce cut short. Retirements are done a little bit earlier because of those types of things. Taking care of a spouse, maybe taking care of an aging parent. These are really expensive costs.
They are. And actually, just my neighbor who lives across the street from me, we're some of the only guys on the street. We actually cut our own lawns. We're like the old guys out there. Hey, we're cutting our yard. And we kind of wave at each other, turn off the mower, kind of meet in the middle of the street and kind of talk a little bit. And I wasn't aware of this, but he's been providing care for his dad. His dad's been living with them.
Oh, wow.
For 15 years.
15 years.
And so he originally thought when he was going to help provide care for his dad, when his dad moved here from out of state, that he was going to be kind of helping his dad kind of get situated and on his feet. And he thought maybe it would be about 2 or 3 years. He said, now it's been 15 years, and I'm just planning on keeping him and taking care of him until I can't provide the level of care that he needs.
Yeah.
Because they're trying to kind of push those expenses down the road a little bit.
Well, that's right. I mean, what do you do when there's no money there, right?
Right.
Now it's a burden on somebody else's retirement. And that's the problem, is that you don't want to typically be a burden on your kids. And so the other thing that could kick in here is long-term care insurance. But, I visited with a client about 2 weeks ago. Their long-term, he's 80 years old, 79, 80, long-term care insurance on 80th birthday went from like $600 all the way to like $720. And then the following year in 2024, it's going to go up to over $800.
Yeah.
And it started off much, much less than that. And so that's the problem with long-term care, at least traditional long-term care, is that many people, they bought this in the 80s and 90s. There were hundreds of companies that were utilizing these types of plans, but the actuaries got it so wrong that they've had to continue to increase the cost. And now when somebody's much closer to actually needing it, think about that.
Yeah.
Half the retirees out there, more than half, rely on Social Security just for more than half of their income.
Yeah, I mean, you don't have that paycheck coming in from your employer, or if you own your own business, you don't have that revenue stream coming in anymore. So all of a sudden, you're somewhat on a kind of a fixed budget. Then how do you account for those price increases in the premium?
That's right. And it's many people are saying, hey, I can't continue this. I'm going to have to cut it all together. And that's what's unfortunate about the traditional long-term care. Just like any other insurance, if you don't use it, you lose it. And, one thing, though, with any long-term care is that make sure you back into these numbers. And this should really be done with any and all insurance that's out there, because, many times we say, oh, man, it's going to cost you, $60,000. Well, you need $5,000 a month in coverage. Well, they fail to account for the pension, any other assets, potential equity in a home. I mean, adding all these things up and really getting a very good understanding really is going to help. And I think that that's one of the problems, that we over-insure because we think we need it. Oh man, it's going up so much, we need this. And therefore your expenses they really cut into you, and it doesn't go nearly as far. That's one of the bigger problems. So, be cautious with that, but understand that, don't get overwhelmed by the numbers, especially if you're younger and you're listening to this. I'd start putting these funds aside right now. You're going to be able to use a lot of different types of assets. John mentioned the health savings account. You can be able to use that for some portions of these things. Also, put funds aside. We talk about Social Security, what that may or may not look like. We can get into that another time, because that could be a whole nother day. But I think you need to take these things into consideration. Now, there's also other types of long-term care insurance. There's more hybrid policies, which, companies are getting a little bit smarter on how they do it, more thoughtful, I think. And these are things that are more achievable, and you don't have to undergo as strict of underwriting. And so those are things that people could look at, that you could still utilize and maybe get, where you're not paying and you have a set payment. That's what I really like about something like that, is you actually have a set payment versus, something that you don't know.
Right.
It's out of your control.
And it maybe has like a little life insurance component to it.
Yeah.
So if you end up not needing the benefit, or maybe you don't use the full benefit, if there's money left over in the tank, so to speak, well, then that can pass on to your beneficiaries or your heirs.
Correct.
Right?
Yeah, and this is something I think we'll probably have to do a webinar on because there's a lot of questions surrounding this and really get in the weeds of it. But, so right now we're talking about some of the unforeseen expectations or expenses in retirement. Another one that I see quite a bit, John, is a child in crisis. I mean, how often do you see somebody who, parents are giving their kids money and, day in and day out, and it becomes to be quite burdensome and really I've seen it disrupt a financial plan.
Yeah, so this actually had this conversation last week.
Okay,
actually, where mom and dad they're in that chapter of their life. They're in retirement mode, and they had a conversation with their grown son, adult son, probably late 40s, maybe early 50s, and the son came clean and said, "Hey, mom, dad, I'm having a little bit of financial hardship here." And he's got a pretty hefty credit card debt of nearly $50,000, right? And the parents are in the dilemma of, hey, do we help him pay this, or will that kind of set a precedent where this could keep recurring over and over again in the future? And I get it. Sometimes life throws you curveballs, and you need to fall back on credit cards to make things meet. I get it. Unplanned medical expenses, emergencies. Hey, understand you got to do what you got to do. In this particular instance, this is not the case. This is just pure financial irresponsibility.
Yeah, so that's what is tough. Because like you said, you set a precedent, and you go to bail somebody out in the sense that you made these decisions. And so that's where I always have a difficult time as well. And you always say, well, you think, oh, I wouldn't do it this way until you get put in that circumstance.
Right.
And then it's completely different. And so I get it. I haven't had to not in those yet. Kids are still so young, but a lot of experience dealing with people having to go through this type of dilemma. And this is going to be rather big, especially if it continues, because $50,000, that's no small money.
Pocket of change. And, so the dilemma is, well, maybe they work out some sort of a compromise with him, maybe where they pay some, but he has to be showing and willing that he's paying some too. I mean, there has to be some clear upfront expectations here from mom and dad to their child. They need to say, okay, if we're willing to help you with this, this is what our expectation is from your side. Or, do they even structure it as like an intra-family loan?
Yeah, I think you have to.
But and maybe charge a little bit of that. The IRS sets limits on interest rates on what can kind of qualify for an interest rate for an intra-family loan. We won't get into the weeds here. But, that could be part of the conversation as well.
It could be. The problem that we typically see with that is that once you actually pay that debt off and now the family member holds that debt, they're not so inclined to pay it. I mean, that's one thing that I typically see, like, oh, hey, sorry, mom, sorry, dad, I can't make the payment this month. And then it just begins to continue to go. And so you're really changing habits, setting some really tight structures around that is probably the best thing you can do is with that to protect yourself. But you have to think of this when you give family members money. I don't know if you can always expect to be paid back. Now, I know there are circumstances, but for the most part, I would almost view it as a gift is what we tell most people.
I would too, yeah. I would just think that you're willing to help out your child. In my mind, I'm expecting I'm probably not going to see it back, right? Yeah. But I'm hoping through this process that if I haven't already educated them enough financially up to this point, at least make this some sort of educational. Hopefully your child can learn from it to prevent this from happening again.
Correct. Yeah, that's the bigger thing, right? And so we do see occasionally where it works out great. I know there's those circumstances out there though where it just doesn't. And so be cautious with that. Think of these as gifts, understand the parameters, and really I think setting some better boundaries, and then also explaining and making sure that you're instilling some type of responsibility surrounding this, especially with an older child. Like you said, you're going to have medical events, other things that occur that you're going to want to help.
Sure,
and that's okay.
Of course.
That's great, but sometimes it's a little bit harder than that. We're going to finish this up. We're getting to our last segment here. Talk a little bit about down market survival guide. What should you be doing in this environment? You're listening to The Real Investment Show. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hurricane season is here, and along the Texas Gulf Coast, we know how to prepare. What we don't always know is which way the storm will go, and if a hurricane does come your way, whether your house will flood. Fortunately, you can get flood insurance. Unfortunately, flood insurance rates have skyrocketed. Don't be at risk. Let the specialists at RIA Insurance assess your needs and shop your coverage for the best rates possible. Another service from realinvestmentadvice.com. Click on the insurance tab, realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the Real Investment Show. I'm Danny Ratliff here with John Penn. So, lots of questions, John, about what do you do in a down market? How do you survive this? And I think, there's some timely things that many people can do. And, one of the things that sometimes people do is they put blinders on. Like, I'm not going to look. I'm not going to make a change. I'm not going to do anything. Yeah. And it's easy to do. And I know we have lots of conversations where people say, you know what, I invest and just set it and forget it. And the industry teaches us that's typically okay. It is okay in an up market to some extent.
Sure.
Now, could we always do better? Yeah, of course. But many people who only have savings in 401ks, retirement plans, that's unfortunately what they've done. And now that we've seen a pretty significant downturn, they're like, whoa, I'm not sure I want to take a look at that.
Yeah.
And that can be a big mistake because if you don't know where you are, how do you know where you're going? And especially if you're getting nearer and closer to retirement, that can become a bigger problem than most people would anticipate.
Yeah.
If you're seeing a bigger downturn. So what do you tell people when you're visiting with them as far as, kind of assessing where they are?
It's one, you got to take a look at it. Right, as hard as it is sometimes, you got to open up the envelopes. You got to look at your account statements if you're still getting the paper, like the old. I like paper too. I'm kind of old school, or just log into your accounts and you got to take a look at where your balances are, where do you stand, and just take a really good look at it and get an idea of okay, so the markets have pulled back this year. Okay, where are you right now, and really where do you want to go, and what are the steps that you need to take now in order to get there? So I think that's really the first step, and it sounds so basic, but you really just kind of have to get your arms around where you are right now, and you can't be afraid to take a look at it.
Yeah, I think that's the key is that understanding, the whole aspect of it, and then understanding, we talked earlier about do you get all the way out?
Yeah.
Are you all the way in? And I don't think that there's ever really a time that anybody should do either, right? I think there's going to be a time where, we want to be all in when we have the wind at our back or prices are much cheaper. We discussed doing that is probably one of the more difficult things to do while investing is buying when things are really cheap because nobody feels good. Somebody's out of work. The economy's been bad. But, look at what's just occurred. We had the market tanked really before the economy. And a lot of times the market's going to be that leading indicator that's going to, we're going to have that leg down prior to actually seeing, getting the economic data that's going to say, hey, you're in a recession. Or, like Lance has been talking about, we're moving in towards a earnings recession. We look at all the companies who have poor guidance for the future. They've lowered their estimates. I think that's going to be something we're going to see a little bit more of. And at that point, we may actually see the bottom, and that's going to be where that opportunity lies. And that may not be far down the road. But, as Lance says, that's those exogenous events. But, another thing that I really love right now, and I think one of the bigger mistakes that people make in this type of this part of the cycle is they stop contributing to the 401k or stop saving altogether. And that can be a big mistake. I think you could turbocharge that and really take advantage of this. We talk about buying low. And, there's a lot of companies out there right now that we like, and we think that, some of them we're holding on to. We have clients that are holding on to them because we think, hey, in a year, 2 years, they're going to be higher than where they are today. And I think if you can buy things when they're cheaper, though, as well, that's a nice thing to have that wind at your back in this environment.
Or what I'm noticing too now that, and we have had the pullback in the market, right? Yes. Can it go lower? Yes, it can. But now folks are starting to kind of get a little bit excited.
Yeah.
Because things are starting to look like they're on sale a little bit.
That's
and
right.
So when you're talking about turbocharging savings, they're looking through their budget and they're figuring out, okay, if I can trim back here, or maybe I don't need to do this expense. Hey, I'm not going to spend the big trip this year. I'm going to take that money. I'm going to put it over into my savings. And they kind of look at it year by year and say, I plan to save this much this year, this much in 2023, this much in 2024. And over time, that's incredibly significant, right?
It adds up. And so I think that's a big part of the savings aspect is understanding where can you pull those funds from and really getting we talk about the 4-letter word, the budget.
Right.
Nobody likes the
B
budget.
word.
But that's one of the things that I think you're seeing successful people do who will do well in retirement because they understand where those funds, where they're going, and they understand, I can cut back here because then I can put funds here.
Right.
And you're right. We talk about the optimism surrounding where we are. I don't know. That kind of scares me a little bit too because I think when we want to really invest, nobody's going to want to invest.
Yeah.
It's going to be that type of environment. Maybe not. Who knows? We'll see what happens here. But one of the other things that many people can do in this time is take control of your retirement date. Now, I think this is a little bit more difficult. We always want to say, well, I'm going to retire at this stage. And we actually find out that people retire, the average retirement age is like 62, 63. Most people say they're going to work till 65, but those things we've talked about in the sense of people, you're taking care of a loved one. Those unforeseen expenses or expectations or things that just happen. That's what I think sidetracks many of these plans. But if you can control it and you can say, hey, I can continue to work or I can do contract work or I can work a bit. We've talked a lot about all the people out there who they're doing side gigs.
Yeah.
Or they go work at Home Depot or Academy, Bass Pro Shop, doing things or, working somewhere where they have a passion for it.
Yeah. I mean, so not just a couple of weeks ago, visited with a gentleman and he's in his late 70s. I mean, he doesn't look like he's over 60. I don't know what his secret is. It's probably because he's still working and still very active. And he just said, when I do decide to I just love what I do. He said, John, I just really love what I do. I don't see it as work. And I'm very blessed that I can continue to do my job very well. But at some point, I do want to step away, work less hours. I'm just not the type of person to just kind of sit at home and do nothing. He said, I'm going to go work at Costco and be a greeter. I just love talking with people. I said, well, go do it. Right. And so to your point, that retirement date, it can be a moving target. At least put something in place to say, okay, by this age, whether if it's 60, 62, is it 65 years young, where I say, hey, at this point, I either want to see if I can retire fully or, is it possible? Can I even retire fully? Or will I need to have a couple years of some part-time income, consulting work, just to help supplement that kind of that transition as you're going into those kind of those retirement chapter years of your life. So we've seen where 2 to 3 years of some, even just part-time income can be so significant where you're not necessarily having to pull from the portfolio yet. The portfolio doesn't have to do all the heavy lifting at that point. You kind of phase into it.
That's right. And I think that's the big aspect. We like to say, okay, we want emergency funds. We also want a financial vulnerability cushion. And that may be for just, life throws you a curveball and you need to make a big change. But also, we also want to plan within the financial plan, what happens if you go to retire and the markets crater? Can you survive that? And I think that's one of the bigger things that needs to be looked at. And if you're using realistic expectations or even even maybe they're not so realistic in the sense that we're going to really stress it and say, hey, you're going to have really low returns. You're going to have bad years. And historically, after bad years, you have some of the best. But we're going to say we're not even going to have that. We're going to have really low returns right after these bad years or a recession. Can your portfolio withstand that? And what does your withdrawal strategy look like? How are you pulling from these funds? Do you have that cash buffer where you can say, hey, you know what? I don't have to pull from this asset at the moment. I can pull from other areas, which is going to give you the ability to see these things come back. We've talked about the lost decade. If you invested in 2000 and stopped in the S&P 500, how long it took back just to get back to even. It doesn't mean every year is bad. And if you read the newsletter or even just listen to the show, a lot of times you'll hear Lance say, we think we're going to struggle to have better returns or higher returns. And we may see lower for longer. Now, that doesn't mean that every year is down or zero. It just means we could see a year like this year where, it's down a little bit more than usual, quite a bit more. What's the impact? And how long does it take for somebody to get back? Now, it's even worse when you're taking out distributions.
Yeah, it is. And so, and part of our portfolio strategy, we always have some cash component in there. And like Danny mentioned earlier, we're holding more cash. So we've been raising cash from the beginning of the year, just so portfolios can be positioned more conservatively in the volatile environment. But outside of what, let's say, even in portfolios, we prefer clients to have an extra set of cash funds set aside for that very reason. A couple weeks ago, visited with a gentleman who he lost his job due to COVID in April of 2020. He just now found work.
Wow. Yeah.
So, but he had 2 to 3 years worth of expenses set off to the side that he was able to pull from. And so even with the market being down this year, he had the flexibility where he wasn't having to pull from assets that were pulling down. He wasn't having to sell equities when they were at a loss position just to get principal out of his account.
Well, that's the key is that do you have that cash buffer?
Right.
Do you have other funds set aside that are going to allow you to do so? And also, do you have the gumption to be able to say, hey, we're going to stick this out in this aspect, and maybe you've already raised some cash, took some profits. That's always a great thing. We think we're more buy, hold, monitor, sell, never typically all in. Now, beginning of the year, we had very little cash on hand.
Right.
It's a much different story today. Now, would I like to have more? Heck yeah, I think everybody would at the moment. But that's all part of it. But you also talked about people having to make lifestyle changes, and I think that's one of the bigger things that we can control to some extent. We had a lot of clients who back in 2020, they lost their jobs. I mean, many were saying, hey, Danny, don't worry. I always fall back on our feet. We get a job quickly. Especially here in Texas, very big component, the energy industry is makes up a lot of where people work. And it just didn't happen as quickly as most people anticipated. So, and a lot of their friends who they typically could rely on to call, they were out of work as well.
They were.
So now they said, okay, you know what? We're going to sell the house. We're going to cut back. We're going to lower our expenses in these areas. And we're going to make this work. And many were able to do so. But that's not the easy way. That's a very hard decision to make. And, you hope and pray like your client just saw. They went back to work and things are good.
And one gentleman, he drove a school bus.
Yeah.
Just to help make ends meet for his family. I mean, he did what he had to do to make it work. And I tipped my hat to him. I said, good for you.
Heck yeah, that's awesome.
Yeah.
Well, hey, guys, thanks for joining us today. I know we talked about some of those things that just aren't so fun to talk about, life and death and all the things in between.
Yay!
But, yeah. Hey, you're listening to Real Investment Show. We'll see you guys tomorrow. Rich Rosso and Chris Behan will be here. An abbreviated version while Lance is out. We'll be back. He'll be back here next Monday. Look forward to seeing you guys this week.
It's a rich man's world.